Alrighty. So if you want to be consistently profitable when it comes to trading options, then there are 5 mistakes that you definitely must avoid at all costs, right? Because if you were to do any of these mistakes, then not only will you find it very difficult for you to generate a consistent income, but there are times where you could potentially blow up your account, right? So these are 5 mistakes you definitely want to avoid like the plague, starting with the very first mistake. Mistake number one, and that is buying premium instead of selling premium. Now, first of all, don't get me wrong, there are certain times where you can certainly buy premium, right? I also have certain trades where I'm long premium instead of short premium. But the thing is that you do not want to have most of your capital allocation into buying premium. Instead, you want to have most of your allocation of your capital into selling premium. And the reason is because when you are buying premium, these are generally directional trades where you need to be right on the direction in order for you to be profitable. And as we already know, if you want to be right on the direction, it is going to be very difficult, right? That's where a lot of people try to predict where the market is going, but instead, they end up losing a lot of money. On top of that, you have theta working against you, right? With your long premium, then you have time decay working against you. It's going to decay the value of your options over time, even though you may be right on your direction. But if it does not move fast enough in the direction of your trade, you are still going to lose money, especially if you were to buy something like the far out of the money call options, right? That's what a lot of new traders do because they think it's very cheap and they want to try and make a lot of money. But for the most part, you're going to lose money most of the time. Now, whereas when you are selling premium, you do not have to be exactly right on the direction. Rather, you just have to not be very wrong on your direction. And I'll explain this a little bit later. But when you're selling premium, now you have theta working for you. You have time decay working on your side. So each day, this theta is going to help you make a little bit of money each day as time goes by. All right, so let me explain a little bit by what I mean that you do not have to be very wrong on your direction. So let's say, for example, you are bullish on the underlying stock, and there are 2 ways for you to put on an option trade, right? Let's say there are 2 options. The first option is to put on a bull put spread, which is a credit spread, right? That means you receive premium for it, you are selling premium. So in this case, you can see this is a bull put spread. So this way, the market, right, it does not have to go up in order for you to make money. It can just go sideways, or it could go a little bit down. As long as it does not go past your short strike at expiration, you will still be profitable and you get to keep the full premium which you sold it for. Now, on the other hand, if you were to buy premium, right, the other trade would be a debit spread, right? A debit spread, this would be called the bull call spread. So in this case, in order for you to be profitable, the only way you can make money is if the market goes up. If it goes sideways, if it goes down, then most likely you are going to lose money. So as you can see, this is pretty much almost like a coin flip, right? 50% that you are going to make money, 50% that you are going to lose money. So, it's much harder for you to be profitable if you are going to be long premium. So buying premium trades will always have a lower probability of profit compared to selling premium trades. So in order for you to make money, as I mentioned, you must be good at picking directions. And if you're first starting out, especially if you're just starting trading or trading options, you're not putting yourself in an advantageous position if you're just trying to pick directions, right? When you are trading options, the advantage you have is that you can actually sell premium for you to have a high probability of win, right? You can put it in a way where you can have this high probability of win compared to only just having, a 50-50 kind of chance to make money. So when you are trading long premium, the best result that you can have, the best probability win rate that you can have is 50% because of just the nature, the way you design the spread, right? In certain cases, you could even get lesser than that. For example, like a calendar spread, or some people like to trade, out of the money call spread. So it's going to be very difficult. Whereas for a short put spread, when you're selling premium, you will always have a more than 50% win rate if you construct it the right way. Now, there is what I call the hidden danger. So the hidden danger of buying premium is that lower probability trades have longer losing streaks compared to higher probability trade. So this is something that not many people actually think about. You see, when you are doing such kind of tradings, when probability is involved, you need to understand what is your longest losing streak that you could possibly have, right? For example, if you put on a 50% win rate trade down here, you can see that it is very possible for you to have 4 losses in a row. Right, if you go out to maybe 7 losses in a row, you can see it's pretty much a 50% chance that you could have 7 losses in a row, which is very, very possible. So many people, when they approach trading, they want to win most of the time. I mean, who likes to lose, right? But the problem is that they don't understand the nature of their trade. So if they were to put on, like the bull call spread with a 50% win rate, in this case, they could face long losing streaks, such as 7 losing streaks, right? So imagine you put your trades on. The first trade that you put on, you lose money. The second trade that you put on, you lose money again. So you keep on putting the trades until you reach, let's say, for example, 4 losing trades, and suddenly you start to doubt your strategy. You start to doubt yourself and say that, man, I don't think that this is going to make me money. So what do you do then? Suddenly you may just jump to another strategy, and then you abandon this strategy when the next could be the profit that you could have made if you put it on. So the problem with this is that not many people reach a point where they could be profitable, even though it could be profitable, right? This strategy could be profitable in the long run if you stick with it, but not many people, especially newer traders, are able to hang around to be able to see the profit at the end of the day, because this 4 losing trades is going to scare you out of the trades, right? It's just going to scare you out. You're going to say that, oh man, I lost 4 trades. I'm afraid to lose the next one. I'm not going to put on the next one. And they jump to a next strategy, which is again similar win rate, right? So this is the problem, the hidden danger of such kind of low probability trades, which is that it affects your trading psychology, right? Trading psychology is very important. Now, on the other hand, if you have an 80% win rate, guess what? Your probability of loss, or rather your losing streak, is going to be much lesser. In fact, if you see like 3 losing trades, you have a 54% chance, which is very possible. But once you go to 4 losing trades, it drops down to 14%. It goes to 5 losing trades, it drops down to 3%, which means to say it's very unlikely. Although possible, it is unlikely. That means for the most part, all you're going to see is probably up to 3 losing trades. So this is going to help you with your psychology much more, right? You're going to see, all right, I have 3 losing trades, and then next one, I can still put it on. But if you were to approach your trading strategies, like say with a 50% win rate, then you gotta be prepared for such a long losing streak, which not many people is able to withstand, right? They're not able to do this for the long run. So the next thing is that when you are selling premium, now that you have a high win rate, right, which means to say your losing streak is long, there's always a trade-off. So the trade-off is that your risk will generally be higher than if you were to put on those long premium trades. So this is where you really need to manage risk, and this is where the next mistake comes. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So mistake number 2 is focusing only on profits and ignoring risk. So one of the issues with many of the new traders when they first come to trading options and they're just exposed to this whole world of selling premium, getting money up front, right? They get all caught up by this amount down here. They see that, wow, when I put on the trade, I can make $250 on the trade, right? This is the kind of mentality they have because you get it up front, right? So when you get it up front, people just have that comfort, that thinking that, this money is all mine. But what they don't realize is that they could actually lose this money. So how do they put on the trades? Well, first off, when you put on the trade, you need to first see the buying power effect, because this is the capital requiring you need to use to put up this trade. So when they think that, all right, I put on a trade and I see that I can make this premium, now I want to see how much I can make, right? A lot of people focus on how much that can be made. So let's say, for example, if they start off with a $5,000 account, right? They start off with $5,000 account, and given that maybe this could be a 70% win rate strategy, they might be telling themselves, most likely I will be a winner for this next trade, right? I'm going to make this money. So if I'm going to make this money, how much do I want to make? If I have $5,000, then guess what? I can put on 5 options, all right? 5 contracts of this and make $250 times 5, and that will give you $1,250. So when they see it this way, they say, wow, that is a lot of money that can be made. This is 70% win rate. I don't think I can lose money. I mean, it has already dropped so much. The stock has already dropped so much. I'm sure you have already heard this quite often. You've heard it, some people say that the stock is so cheap now. What are the chances of it dropping even further? So this is where the risk comes. And because of this mistake of focusing only on profits, it leads you to the next mistake, which is a grave mistake that can potentially blow up your account, and that is trading too big, right? When you trade too big, this is where a lot of sleepless nights come, especially when the market crash, right? As we have experienced in 2020 during the pandemic crash, and also 2022 when the Fed starts to increase interest rate very aggressively to curb inflation, right? So when the focus is only on how much money can be made, you start trading too big, right, for your account size, and this can lead you to blowing up your account when the trades go wrong. So here is a quick trivia for you. Here's a quick question to see how well you know in terms of managing your risk. So let's say, for example, you have a $50,000 trading account and you have this trade on whereby you can make $250 premium per trade, and to put up this trade you just have to put up about $1,000. How many contracts should you sell? Right, give yourself about a few seconds to come up with the answer. All right, so what is the answer? How many contracts should you sell? So the answer is, with a max capital allocation of 5 to 7% per trade, well, the most contracts that you can sell is actually 2 to 3 contracts. Now this may be a little bit surprising to you because $50,000 sounds like a pretty big account compared to how much you could put up, right? So when it comes to this, right, many people would say that I could probably sell 5 or maybe even 10 contracts, and that will make up $2,500. And that's where you hear people talking about things like, wow, I just made $2,500 today, easy work, right? But the thing is that they are ignoring the risk, right? When the market crashes, which it inevitably will, right, this is something that you must account for in your trading strategy. When that time comes, they're going to really blow up their account. So as you can see, even though you have $50,000, at most, based on your allocation of 5 to 7% per trade, right, the most you can sell is 2 to 3 contracts. Now, what if you had instead a $20,000 trading account? So how many contracts should you sell? So by now you should already know that with a max allocation of 5 to 7% per trade, the most contracts you can sell is 1 contract, right? Just 1 contract, right, for this trade. But if the market moves again, then you can reassess the situation, and then you could put on another trade, right? It could be the same trade with maybe different delta, or you can put on a different strategy. But for this singular trade, right, you can only allocate at most 5 to 7% if you want proper risk management. Now, what if you had only a 10,000 trading account, right? Most people start off small, so you have maybe 10,000 even, or maybe even lesser. How many contracts should you sell? Well, the answer you should know by now is that you can't sell any contracts, right? You will have to find a smaller product to trade if you have this account, right? So if you have a $10,000 account, 5 to 7% of that will be roughly $500 to $700, which means to say you need to find a product where when you put on the trade, the buying power effect is roughly around this amount. Then you can put on the trade, right? If you can't put on this trade, then chances are, all right, for this you can see it is a short put, right? So this is an undefined risk. So if you cannot put on this trade, you find it's a little bit too big for your size, then you may need to define it, right? Define it, that means you need to buy a put option further out of the money to turn it into a bull put spread, right? So you turn a short put into actually a bull put spread, and then you see the buying power effect, and you see if it's within $500 to $700, then it's a green light. You can go ahead with that trade. Now, mistake number 4, which not many people surprisingly actually talks about, is actually holding your trade till expiration, right? Many of times when people put on the trade, they look at the risk profile and they think that, the way for you to trade this strategy is to hold till expiration. So the thing is that other than the put ratio spread, right, that is on the cash settled index, that is one of the strategies that I trade, where I actually hold to expiration because it's a slow moving trade and there's no risk of early assignment. But for the most part, if you trade individual stocks, if you trade index ETFs, then there is really no reason for you to hold all the way to expiration, because there is a chance of early assignment. And also there has been numerous research findings and studies by the Tasty Trade team that have shown that if you were to hold your trades to expiration, your risk significantly increases and your P&L actually decreases, right? So this sounds a little bit counterintuitive, right? Because people think that if you hold to expiration, you can realize the full profit of whatever the premium that you got at the start. So why should you actually get out early, right? Why should you manage your trades early? So the research, as you can see, have really shown that you actually get better performance, better results if you were to manage it early. So this is for a put spread. So this is a short put spread, which is the bull put spread. So the thing is that if you were to hold to expiration, you can see in terms of win rate, the win rate is actually higher, which makes sense, right? Because if you remember the risk graph, let's say for example an iron condor risk graph, right? This is an iron condor risk graph at expiration. This is the shape it will be at expiration. But prior to expiration, right, the graph could probably be like this, right? And then as it gets closer and closer to expiration, it keeps increasing until this line down here fits this expiration graph. So if you were to close it out early, then your win rate will be reduced because you actually have a smaller profit zone, right? You have actually a smaller profit zone, if you see here, right? I haven't drawn this accurately, but basically you have a smaller profit zone. So that is why your win rate will generally be slightly lesser than if you hold to expiration. However, even though you do that, you actually have a higher return, right? You can see your return down here. When you manage it early, your return is higher than if you were to hold to expiration, and the reason is because of the losses, right? If you take a look at the losses down here, you can see that if you will hold to expiration, your losses is much significantly higher than if you were to manage it early, right? You can see it's almost 3 to 4 times larger if you hold to expiration compared to if you manage early. And by the way, managing early means to manage it around 21 days to expiration, right? So that means when there's 21 days to expiration, you either close it out or you manage it by either rolling or adjusting it, right? So as you can see down here, the research has already shown that if you manage it early, you will have better performance. And it makes sense also because, for example, if I give you 2 timings to run, right? Let's say if I give you 1 minute to run to see how far you can get, as far as you can run, versus if I give you 5 minutes to run, right? I give you 1 minute to run versus 5 minutes to run. Now, in these 2 timings, which one do you think you can get a further distance in? Which one can you run further in? Of course, the 5 minutes run, because you have more time to run. So in this case, if you leave the trade all the way to expiration, you're actually also giving your trade more time to go against you even more, right? So that is why when you go, right, when you manage it at when it's early, then it's not going to be going against you if the trade is wrong that much, right? It's exactly like this. You only have 1 minute, basically. You can't run as far as if you will have 5 minutes to run. So in this case, you are really managing your risk and you are increasing your performance. Now, as you can see down here, here's another study where they talk about the probability of loss exceeding the BPR, which is the buying power reduction, right? Which is the number which I showed you previously, this number down here, right? So what is the percentage, the probability of loss exceeding that number? So as you can see, if you were to hold it to expiration, right, on certain stocks, index ETF, you actually have a chance for you to hit that number. So although it is small, there's still that probability. So you can see for the SPY, there's a almost 1% chance for you to hit that buying power reduction. And for individual stocks, like for example, Amazon, Apple, roughly 2 to 2.6%, which means to say the chances of you losing more than what you actually put up for the capital, right? For this, you actually put up $1,000 to put up this trade. It is very possible for you to lose more than that. Now, that is a very dangerous thing, right? Because you can easily blow up your account and lose more than you actually have in your account, right? But when you actually manage it at 21 days to expiration, all of a sudden your chances, right, of exceeding this buying power requirement reduces dramatically, right? In the spiders, in fact, as you can see it's 0%, right? There is no chance for you to exceed this buying power reduction, which means to say whatever you put up for this amount down here, would be most likely the maximum loss that you could experience when you put on this trade, right? Especially when it's an undefined trade. So this really applies to undefined trades like the short put, the strangles, and strategies like put ratio spreads like that, right? Whereas for the Amazon, you can see there is still certain risk, right? There's still at least a 1%, close to 1% for the Apple, 1.1% for Amazon, that you will exceed the buying power reduction. But as you can see, it has been reduced dramatically from here to here. So that is why when you manage it early, you can actually have a better performance. So again here, this is another study done by the Tasty Trade team. So again, you can go over to the site. They have many studies, and especially when you're trading options, these are all probability based. These are studies that have been done for many years. All right, so that is why when we make our trades, our assumptions, we want to lean on statistics and hard facts rather than just the opinion of just someone, right? So from this, you can see this is of the Iron Condor. If you were to manage it at 21 days to expiration, you can see the performance is much better than if you were to hold it to expiration. And this is for the short put. Again, same thing. You can see in 2008, if you were to manage it early, you actually miss this huge drawdown, this huge downswing in your P&L during the financial crisis. So it really helps you manage your risk. So last but not least, we have mistake number 5, and that is not having an exit plan. Now, of all the mistakes that I've mentioned so far, this mistake is one of the most common mistakes that many people have, especially newer traders. And this can actually lead you to one of those situations where you're like a deer in the headlights and you have no idea what to do when the market crashes or the trade just goes against you and you're losing a lot of money because you didn't have an exit plan in the first place, right? So many traders, including veteran traders, make the mistake of not having a proper and thorough exit plan that includes when to cut loss, right? Because in general, we don't like to lose money, right? Who likes to lose money? We don't like the realization that we have actually lost money, and then it feels very painful. So to avoid that, we do not have an exit plan, do not have a plan to cut loss, or some people have a plan to cut loss, but they cannot follow it because they just don't want to click the button to admit that they have lost. So because of this, we avoid planning for the scenario where we take a loss. So as you can see, this is one of my subscribers where he have actually let the trade on a little bit too long and he started to lose quite a bit of money, which I've actually covered in a previous video. So this is not something new. I have a number of people have emailed me that they have lost a lot of money and they are not sure what to do. So if you have reached the point whereby you lost a lot of money, that you have to reach out to someone to ask what to do, it means you already have made this mistake that you do not have an exit plan, right? So you must have an exit plan that is thoroughly planned from beginning to end. So what does this mean, right? What exactly is a thorough exit plan? So having a thorough exit plan means to account for all the different scenarios. And by what I say all means every single scenario that can happen under the sun, you have already planned for it and you already know what you're going to do in advance before the scenario happens. So then you have a plan of action for each scenario. So all you have to do then, once you already have the plan, is that if that scenario actually plays out, all you have to do is just execute your plan. There's no thinking involved. There's no, uncertainty. All you have to do is just follow according to the plan and do it. All right. So let me just walk you through exactly how to have a proper, thorough exit plan. So let's take a very simple, straightforward strategy, and that is the short put. So let's say, for example, on this stock, let's just say you are bullish on it, right? You think the market is going to go up, so you sell a short put, right? An out of the money short put. So the first thing you need to do is to account for the different scenarios, right? What are the different scenarios that can happen after you put on this trade? So the first scenario you want to plan out for is when you make money, right? When things are going your way, right? So these are certain things some people also do not plan out, but you need to know, right? So let's say, for example, scenario 1 is if Google stays above $100, which is above your strike price, this is a good thing. So the thing is, at which point do you exit? At which point do you actually take profit? Right? Do you take profit when it's at 21 DTE? Or do you take profit when it's a certain percentage of your profit, like maybe 50% profit, 75% profit, whatever it is? Or do you get out at a certain price level? Let's say, for example, maybe the stock goes up to 120, then you say, all right, this is where I'm going to exit the short put, or maybe if the indicator, right, the stochastic indicator says that it is overbought at that point, then you could get out, right? So all this have to be really planned in advance and not come down to discretion. Otherwise, you could reach a point whereby you could take a profit, but because you didn't, the market came back down and then you hit your short strike, and now all of a sudden you're in a loss, right? So this is where you need to be clear on where to take profit. So that's scenario number one. Now, scenario number two is slightly harder because most people don't like to face losing trades. So what happens if Google goes below $100? What will you do? So first thing, will you cut loss? If so, if you're going to cut loss, at which point? Are you going to cut loss at a fixed number of days left, or are you going to cut loss once you reach a certain amount, certain dollar amount, right? Or will you do nothing? Right, so there are certain times where you could do nothing, especially if there are still many days left in the trade, right? If there's still like 30 odd days, 40 odd days, then there is a chance that you could do nothing. Next is, will you roll, right? If so, if you're going to roll, if the market comes down below your strike, the question is, how are you going to roll? Are you just going to roll out to the next month, or are you going to roll out and down? Or in certain cases, some people a little bit more advanced, they may want to roll and then add a short call on top of that, right? So they sell a call option, effectively turning this into a short strangle, right? But this is much more advanced. I'm not going to go into this into detail, but what you need to know is that if it goes below here, you need to have a plan, right? What are you going to do, right? Scenario number three. So let's say, for example, you decide to roll. Now you can see most people stop at scenario number two because they have just decided, all right, if it comes down here, I'm going to roll, right? But what happens if the market keeps dropping again after that? What are you going to do? Or if the market goes up, is there a point that you're planning to roll up? Or are you just going to, just wait it out until it expires out of money? So this is where scenario three comes in, which is the next step of the next step, right? So after rolling, Google goes above the strike price. So let's say you roll down to $96 and now Google goes up here. What will you do? Will you continue holding on to the trade? Will you roll up? Will you exit the trade? If you want to exit the trade, is it going to be at a break even at 21 days to expiration, or is it at a certain percentage of the profit? All this have to be planned out. And finally, let's say in scenario 4, after rolling, Google goes down even further. You rolled down to $96, right? Now this is your new strike, but Google continues to go all the way down. What do you do, right? Will you hold? Will you cut loss? Will you roll? How will you roll? So as you can see, there is a kind of like an order tree or order chain in a sense whereby you really need to know what to do, right? Your decision tree, you need to do if, for example, A happens, what are you going to do? And it leads to B and C. From here, what are you going to do? Right? So all this has to be planned out, and this is what I call a thorough plan. So when you have this thorough plan, you can avoid such kind of losses, because chances are that you could have cut loss earlier on. You could have saved yourself so much more money rather than to hold the trade on, and then now suddenly you are in a very, very big red loss. Right? So let's have a quick recap of the 5 mistakes to avoid like the plague, right? The first mistake is to not buy premium, right? The first mistake is buying premium instead of selling premium. Basically, you want to allocate most of your capital to selling premium, because this way you have a higher probability trade and you're able to generate more consistent results for yourself. Mistake number 2, focusing only on profits instead of factoring in risks. So this is where you need to know your risk. And from this mistake, it leads on to the next mistake, which is trading too big, which is where you need to have proper position sizing. You need to allocate it properly. Mistake number 4 is holding it to expiration. So instead of holding to expiration, you want to manage it early, right? Somewhere around 21 days to expiration. In this way, you will be able to get better results. And finally, mistake number 5, not having a thorough exit plan, including when to cut loss. So this is where you really need to sit down, plan your trades properly, have a proper exit plan, and when those scenarios actually play out, all you have to do, there's no guesswork, just execute it. By the way, if you like this video, then you're absolutely going to love this next video which I have for you, so go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. Alright, I will see you in the next video.